Hello, everybody. At this time, we are talking about bad debt. Bad debt occurs when a company determines that money owed to it will never be collected. It would be because a customer becomes bankrupt or otherwise insolvent, or it could be due to a dispute over an improper invoice on the quality of goods or services. For example, a company might deliver products only to face a customer's dissatisfaction, leading to a dispute and refusal to pay. If resolution efforts falter, the company must classify the outstanding amount as bad debt. Accounting standards require that uncollectible debts be classified as bad debt not merely on the basis of an expectation but because of evidence or reasonable assumptions. Then the amount of the bad debt must be written off from the company's accounts receivable ledger. That would lower the company's reported net income for the period in which the bad debt is discovered unless there is a mechanism to mitigate the impact. And then, why and how do bad debts occur? In most cases, the reason is simple: your customers simply cannot pay the bill due to insolvency or bankruptcy. Your customers may be experiencing delays in payment themselves. They may be enduring supply chain problems that are showing down deliveries of components they need to manufacture the goods they sell. Your customer's bank credit line may have been withdrawn, sustaining his or her operating capital. The market may have turned down suddenly, impacting sales and the overall business model. It could also be that you've extended credit to an unsuitable customers. If this is the case, you should tighten up your credit control policy to prevent it from happening in the future. Bad debt can also be the result of credit fraud, in which your business has been deliberately targeted by common and minds, or a customer misrepresented himself in obtaining a sale on credit from your company and has no intention of ever paying you. Keep in mind that the first sign your receivables are in danger of becoming a bad debt is late payments of invoices. And then we move to the impact of bad debts on finances. The first impact: profit. When a customer or business fails to pay the debt which is owed to the business, there is a direct impact on the business profitability. The sales that would normally occur will compensate for the business loss. Extending credit to businesses who cannot repay the debt, and when it fails, do result in a decrease in revenue and an increase in expenses. As bad debts are part of business expenses, any payments which are not made when they fall due disrupt the next income of the business. The second impact about cash flow: incurring bad debt has a chain reaction to the internal operation of the business. When a business finds themselves not being repaid for the credit they have given, profit and cash flow are often at risk. When a customer or business fails to pay the debt which is owed to the business, there is a direct impact on the business profitability. The sales that would normally occur will compensate for the business loss. Extending credit to businesses who cannot repay the debt when it falls due result in a decrease in revenue and an increase in expenses. As bad debts are part of a business expenses, any payments which are not made when they fail do disrupt the net income of the business. And then we move to criteria for bad debt. The receivables have reached a certain age. Every company has policies and rules regarding the aging of receivables. If the debtor has not paid their debt by the company's set due date, the company will provide a grace period for the creditor to make full payment. However, the grace period given by the creditor also has a limit. If the debitor fails to pay within the limit, the creditor can classify it as bad debt. And then second, collection efforts have exceeded limits. When the company has made repeated efforts to collect and remind the debitor, but there is no willingness on their part to make payment. If the company has exhausted all methods of collection, but the debitor still does not pay, the company needs to classify the debt as bad debt. And then third, creditor experiences bankruptcy. A debitor experiencing bankruptcy is also another criterion for bad debt. Usually, there are collateral items involved in the credit transaction made by the consumer. When the creditor faces problems and is unable to pay the debt, the receivables will surrender ownership of the collateral or other assets for sale, and this allows the loaned money to be recovered. And then fourth, debtor confirmed as unable to pay due to specific events. When the debitor experiences certain events that result in the loss of all their assets, usually this condition is caused by unintentional events such as natural disasters, fires, and various other occurrences. And then when is an invoice considered bad debt? Bad debt is essentially any amount of money that you as a creditor must write off when a client is unable to pay. This happens when your client, whether an individual or a business, demonstrates that they cannot pay what they owe either partially or at all. If this is due to, for example, bankruptcy, there is no pain trying debt collection, and so you can record it as a loss in your accounting. If, however, it is not so obvious that you won't get paid, the government usually requires you to try to collect payment before you can write off the invoice as bad debt. This means sending payments reminders, trying to reach an agreement with the client, such as setting up a payment plan or replacing faulty goals, and even debt collection. I think it is enough. Thanks for watching.